Mauritius's annual average inflation rate fell for the 10th straight month, as to 4.3% in October from 4.4% in September, with consumer price index rising to 133.6 in October from 133.3 a month earlier. Joining us from our studios in London, Geraint Tudor Jones, a Sub-Saharan Africa Analyst at Business Monitor International. Geraint, thank you so much for joining us today. So broadly, if we could start with you just breaking down the inflation number for us for the month of October.
Oh, thank you. Yeah, so I mean, the latest figures are broadly in line with what we've seen throughout the course of 2012, namely a broad easing in inflationary pressures as the impact of a weak domestic economy and externally weak environment are increasingly weighing on price growth. I mean, it's no surprise that the consumer staple groups are going to obviously see gradual easing over the course of the year, and we expect this to continue. At the same time, we've seen a slight uptick in the food price component. This comes as no surprise given the regionally high food prices, which are affecting the food price basket component of the CPI across the region. And this is broadly in line with the key drivers of the economic growth at the moment in the country.
I mean, so where does that put your projections when it comes to inflation going forward? Because, of course, you've also got to take into account possible imported inflation. It's all very much hinged on the outlook for the euro. We've seen current or recent rupee weakness as a result of that euro's rally we saw, but of course very uncertain when it comes to that. But how do you evaluate the risks to inflation starting to tick up once again?
Yes, exactly. Well, I mean, as you mentioned, the broad fundamental pressures on price growth, in our view, still remain very much on the subdued side, given what's happening in the economy and given what's happening in the Eurozone and Mauritius' exposure to that. The Eurozone accounts for around 60% of goods and services exports. And so, with no dramatic improvement expected over the near term at least, we expect the fundamental pressures on price growth to remain subdued. As you've said, there are risks to the inflationary outlook to the upside. As I've already mentioned, the risk of high food prices are persistent, and we expect them to remain an upside pressure on price growth. Likewise, the currency, which has been relatively stable against the euro over the last couple of years, in recent months it's sold off on the back of a euro rally, and this could see imported inflationary pressures rear up towards the end of the year or early 2013. We're currently forecasting end-of-year CPI to come into around just over 3.5%. By the end of the year, year on year.
I mean,
and
yeah.
over the first 6 months of 2013, anyway, we see inflation staying contained between about 3.5% and 4.5%.
When it comes to the economic growth picture right now, you talk about the fact that, of course, very subdued and very much reliant on Europe, being a very Euro-centric economy. But, you know, what is your evaluation as to whether we might start seeing a pickup in growth in spite of what takes place in Europe because of the efforts by Mauritian authorities to diversify their, I suppose, trade with other nations, specifically in Asia right now?
No, that's absolutely right. I mean, while we do see growth being subdued, we forecast GDP growth of 4% in 2013, following an estimation of about 3.2% this year, which is still decent. By no means is this a collapse in growth. We still have a very positive outlook towards the mission economy over the medium term. The investment outlook is very strong. FDI levels have remained robust despite the weak climate, and the mission government's efforts to diversify the economy, to increase their exposure to emerging markets, namely China and India, are also bearing fruit. So over the medium term, we see these factors coming more and more into play. Despite obviously the slow recovery that's going to be taking place within the Eurozone.
And of course, you're talking about what government is doing to diversify income streams. We've got the central bank with the repo rate at 4.9%. Most are saying there's much more room to maneuver monetary policy in order to help stimulate the economy locally. Do you believe that there's room to do that, given your forecast on inflation?
Absolutely. I mean, the central bank's made it very clear over the course of the year that price control is a key priority, despite sort of slowing growth. The repo rate's been on hold at 4.9% since March. While risks of a cut have been mounting, we still believe the bank will hold back from making further cuts over the near term at least. We saw it keep rates on hold at the most recent meeting in September, and given the uncertainty still surrounding the broader external environment, the bank does, I think, just want to keep some powder dry, so to speak, should conditions deteriorate elsewhere. So certainly is that there is room to manoeuvre.
Yeah, well, that is general consensus.